Alright, let's see if we can make an attempt to explain Section 1231 property. So first we're going to go to Investopedia. Let's see if they can give us kind of a decent explanation as to what we got here. Right, Investopedia says, definition of Section 1231 property, a tax term related to depreciable business property that has been held for over a year. Section 1231 property includes buildings, machinery, land, timber, and other natural resources, unharvested crops, cattle, livestock, and leaseholds that are at least a year old. Section 1231 gains and losses are netted against each other in the same manner as capital gains and losses, except that a net Section 1231 gain is considered a capital gain, while a net Section 1231 loss is classified as ordinary loss. So let's say you have one of these items in here. Let's say you've got a machine. So you bought a lathe, it's in your shop, and you've been using it and depreciating it. So you have some number, you bought it for $10,000, and you've been depreciating it, and you want to sell it. Now, you've had it for a couple of years, so let's say the basis is maybe 8,000. So you bought it for 10, you depreciated 2, you got 8 left, and now you're going to sell it. So here's the beauty of what we're saying with Section 1231. Sell it for $20,000. Now you've got a huge gain. You're going to pay capital gains rate on it. Well, let's assume you only could get $500 for it. Now you have a loss. Well, this loss is going to be an ordinary loss. So works out to be a pretty beautiful thing. Alright, so this is Investopedia.com. We got this. Let's go straight to the IRS. Now, this is publication 544. IRS says Section 1231 transaction. The following transaction result in gains or losses subject to 1231 treatment. Sales and exchanges of real property or depreciable personal property. This property must be used in a trade or business and held for longer than 1 year. Generally, property held for production of rents and royalties is considered to be used in a trade or business. Depreciable personal property includes amortizables, Section 197, intangibles. So we're just talking about intangibles now. Sales and exchanges of leaseholds, cattle, horses, livestock, unharvested crops, timber, disposable timber, coal, iron, condemnations, casualty and thefts, yada yada yada. So pretty much IRS is saying the same thing. They just took a few more words to say it. Alrighty. So let's go on to publication 444. Now we're a little lower. This is an example. So part of the problem with Section 1231 losses is when you take a loss, you get a ordinary loss. So let's say you're at the 35% tax bracket, you are benefiting from that 35% rate. And then non-recaptured Section 1231 losses. This is, my definition of it would be your penalty for getting the benefit of the capital gains rates. Well, or more to the point is getting to use your capital gain and getting ordinary loss for it, but then the following year you have capital gain property that this should have been netted against. So here we go. Your non-recaptured Section 1231 losses are your net Section 1231 losses for the previous 5 years that have not been applied against a net Section 1231 gain. Therefore, if in any of your 5 preceding tax year you had a Section 1231 loss, so that was your ordinary loss, so on you had a $10,000 deduction, you're at the 30% tax bracket, it had a value of $3,000 to you, as opposed to, say it was capital gains 15%, that would have been $1,500. So you had an extra $1,500 that you got. Alright, so therefore, if any of the 5 preceding tax years you had a Section 1231 losses, a net gain for the current year from the sale of Section 1231 assets is ordinary gain to the extent of your prior losses. These losses are applied against your net Section 1231 gain beginning with the earliest loss in the 5-year period. So IRS gives us a little example, which IRS examples are usually too complicated but yet too easy. So let's see if we can work through this one. In 2012, Ben has a $2,000 net Section 1231 gain. So again, 12. He sold some office machinery. He made $2,000 on selling it. To figure how much he has to report as ordinary income and long-term capital gain, he must first determine his Section 1231 gains and losses from the previous 5 years. So, from 2007 to 11, he had the following Section 1231 gains and losses. In 2009, he had a minus 2,500. 2011, he had a positive 1,800. So, really, if we were going to make this example really easy, we just net the two of these together, and we have our $700 loss. So what we really have is a non-recaptured Section 1231 loss of $700 for the past 5 years. So as you see, Ben has a $2,000 net Section 1231 gain. So what are we saying? That $2,000 is a long-term capital gain, which is going to be subject to the 15% tax bracket. But net $700 of this, he got an ordinary loss deduction for it. And you know, in our example, if say he was at the 30% tax bracket, he got 30% rate. So you're going to have to take this $700 and it's going to be treated as ordinary income. And then the rest of it will be capital gain treatment. Alright, so that example is pretty straightforward. We go, this is Cornell Law School. They put the actual IRS code. It's www.law.cornell.edu, and we define Section 1231 for us, gains that do not exceed losses, any unrecognized gains, special rules, yada yada yada. So let's move into this article. Go up to the top. Leave this up for a minute so you can kind of peruse it if you want, but basically what it's saying is pretty much exactly what we were saying before, that timing of these 1231 gains and losses can play a huge difference in your tax liability. You read down through here, see right here, client's failure to take advantage of these provisions can result in higher taxes and thus in reduced after-tax cash flows. For many companies, the importance attached to the disposal of capital assets has increased dramatically due to the forced sell-off of non-core assets to raise cash. Let's just do this example real quick. I think this is actually from the Journal of Accountancy. They did a pretty good job here, in my opinion. Exhibits 1 and 2. So what we got here is illustrate the tax savings available as a result of favorable treatment. Keep in mind that under current law, this example is 2009-10. Taxpayers have 10%, 15% margin or ordinary income. So everything's kind of the same, but this example is from a few years back. Assume that in 2009, an individual taxpayer is a sole shareholder in an S corporation, disposed of 2 assets. So one asset got a gain, other is a loss, so they netted a net gain. Come down here, his marginal tax bracket is 35%, long-term gain rate is 15%. So you can see on this, the favorable 1231 gain treatment saved him $3,000. So the difference between the 15% and the 35%. So basically it's a 20% difference. So 15 times 20%, that gives you your savings. Number 2, this is our net loss. So here we have a net loss. You get to deduct the whole 35%. So he got $5,250 deduction for this. So if you see up here, if he would have had to done it at the 15%, he would have only gotten $2,250. Now for your 5-year penalty, you got to look back and recapture. While Section 1231 appears to provide taxpayers with the best of both worlds, the IRS does limit you for the last 5 years. So what you have to do is, this is pretty much the same example the IRS gave us. The company had disposed of 1231 assets in 8 at a loss of $25,000, which was deducted by the owner. So remember, he got an ordinary loss for this whole $25,000 back in 2008, which for us is just the year before this gain. Therefore, rather than being netted with other long-term capital gains and losses, as was the case in Exhibit 1, the entire $15,000 is taxed as ordinary income under the 5-year look-back rule. So, basically, got to put that back in. Loss of tax savings due to the look-back rule is $3,000. So, the only take-home really comment here is if you sell an asset and then you're selling more assets within the 5 years, may kind of jump up to bite you a little bit. So here's a quick example. We'll go through this real quick. It's just the difference between individual and a corporate taxpayer. A business acquired a warehouse 1988 for $780,000. Depreciated using straight line depreciation. Sold the asset for $860. Cumulative depreciation totaled $290. $370,000 1231 gain was computed as follows. So 780 minus 290. So his basis was 490. I already deducted the 290. We're at the 490. Selling price was 860. So 1231 gain is $370,000. Individual, what you figured is you got 370. We don't have any 1250 recapture. Okay, but the unrecaptured 1250 gain. So now what we're saying is it's real property that we're selling. Real property when you recapture the depreciation. So we took $290,000 in depreciation. When you sell it for a gain, you got to recapture that. You got an ordinary loss for it, so you got to have an ordinary gain for that part, or it wouldn't be fair. But you're only limited at 25%, so it is kind of a little bonus there. Remaining 1231 gain eligible for long-term capital gain rate is the 80. But corporation got 370, you recapture it under 1245, which is 290,000. They do a Section 291 recapture percentage, which is 20%. 291 recapture 58,000. The remaining 1231 gain is 312,000. And pretty much goes through 1231. So the take-home points on this really are 1231 gain can be a huge savings. You get a ordinary loss for it in the years, and long-term capital gain in the future. You just have to be careful if you took ordinary losses in the last 5 years and then you got a big 1231 gain after that. Alrighty.